Ever been scrolling and seen one of those ads promising you could be mortgage-free in 5 years? Yeah, it's a big claim, but here's the thing. Not impossible. And if you're staring down the barrel of a standard 30-year mortgage, the idea of paying it off early isn't just some nice dream. It's freedom. But only if you do it the right way. There are plenty of people who would sell you shortcuts that don't really work, while others are quietly using smart strategies that genuinely can save years and hundreds of thousands of dollars. So how do you tell the difference between clickbait and the real deal? Well, welcome to Ask the Experts, where each week we talk to people in the industry to get answers for what's happening in the money world right now. Reminder though, before we get into this, of course, we are answering a letter here, but we don't know the full financial situation, just what's in the letter. So this is general financial information. For individual financial advice, you will need to see a financial advisor. Making Sense has partnered up with EnableMe to get you the strategies for reaching financial freedom faster. Head to their website to learn more. Visit enable.me today. The lovely Shelley Palman from EnableMe, strategic coach. I've got a letter for you. Are you ready?
I'm ready.
Okay, here we go. Hi, Frances. Really want to be mortgage free. And I think my Google history is giving me away because suddenly I'm getting lots of social media ads from property gurus promising me that just changing my mortgage structure can have me mortgage free in 5 years. Now that sounds too good to be true, but at the same time, I really would love for it to be true. So is this actually possible? What are the best tactics for paying off the mortgage faster? Thanks. Now, I've got to say, probably my Google history has given me away too. I've seen so many of these and I see some of them and I think, oh, yes, great tactic. And I see some of them and I think, that is snake oil. So,
Yes.
What do you think, there's a lot of these strategies around. What do you think separates the clickbait from the useful stuff?
So I would say, when I look at these social media posts and having done this for 10 years now, I can really whiff the ones that are just claims, bold clickbaity kind of claims. And I roll my eyes with some of the things that they say. I'm here to say, yes, it is actually possible though. And, I get a lot of my clients mortgage free in 5 years. But when you're looking at who the people are behind these bold claims, I think that's really where you need to start to go. Follow the money. How independent are these people who are claiming to get you mortgage free in 5 years? So when you think about a qualified financial advisor, we are bound by certain processes and compliance procedures around giving this type of advice. We have to declare how we are paid. Ask the advisor, how do you get paid? And it should be on their disclosure document, which you should be able to find on their website. They should be publicly advertising disclosure documents. So follow that trail of how are they making a living? Are they likely to receive a commission for you doing something? Frances, I did want to pick up on some languaging in the question though, because the person who's written in has said, I really want to be mortgage free in 5 years. What I want to get them thinking about is why. What would that mean to you? I would actually rephrase that to, I want to be financially free.
Yeah. And I think that's the thing as well, is even when we're saying, mortgage free in 5 years, which is amazing and a great goal, 5 years is such a shorter time than a lot of people will spend paying off the mortgage. And it's going to save you hundreds of thousands of dollars. Amazing. At the same time, it's still 5 years. That's still quite a long time. And so to keep that motivation going through that time can still be tricky, right?
And humans are famously shocking when it comes to discipline and willpower.
Yeah.
We just are. Unfortunately, it's deeply boring. For 5 years of your life, to become mortgage free faster, you need to be paying off extra principal on your mortgage. That is what I would call the sausage of the financial plan. What is that sizzle? And, what is that thing that's going to motivate you and pull you towards achieving?
So your experience of doing this, what are some of the big changes that can actually move the needle on this?
So it's paying off extra principal over and above what the bank want you to do. So we like our clients to do that in specific ways. We don't just want you to lift your mortgage repayments, because one of the biggest issues with doing that is that you become less financially resilient. you now have higher costs. What if something happens with your job? What if you need to go on maternity leave? You now have really high mortgage repayments. So we want you to pay extra principal, but we want you to do it on your terms, not the bank's terms. So chunking off bits of your mortgage, popping them into either an offset or a revolving credit type product and making extra payments towards them on the proviso that you can reaccess those savings in case of an emergency, because inevitably rainy days do come.
Nice. And why are those extra payments so, especially as you say, paying it onto the principal, which is the amount you originally borrowed in the first place, so powerful, but lay that out for me, why?
Yeah, compound interest. It's not your friend when it comes to a table mortgage. It is your friend when you're investing. But that table mortgage, you do not pay more principal than interest to year 23.
Wow.
On a table mortgage.
I didn't realize it was quite that late.
Quite that bad. Yeah. So it's a really good money-making scheme for the banks.
Works for them.
So what we want to be doing is we want to stop the effect of the compound interest. So you think $1 that you don't pay in compound interest over 30 years is $1 less that you're paying to the bank, So extra bits of principal are absolutely the thing that is going to shift the dial.
Okay. So you mentioned before the offset and the revolving, which are really powerful tools to use on this, can depend based on people's money personality. So offset and revolving, give us sort of brief overview of how those work and when they may or may not be good ideas.
Yeah, so I prefer a revolving credit over an offset. An offset essentially is a floating loan where you make mortgage repayments on a table loan basis. It's just that any money that you have in your other accounts offset whatever is owing. So for an easy maths, if you have a $10,000 offset loan and you have $5,000 in a savings account, you only pay interest on the difference, which is $5,000. So that can be a nice interest win. But the thing I don't like about an offset, again, it comes back to money behaviors, because you have this loan there and you think, well, it's a mortgage, I'm making repayments on it, it's going to get paid off. And you have savings, which in your mind are yours.
Yeah.
Those are my savings. And that is the mortgage over there, which will be eventually paid off. When you have a revolving credit, essentially we sort of transfer your savings in. So you have a $5,000 buffer, and then you have $5,000, which is attracting interest. And what we want you to do is to really channel your savings into that extra $5,000 to get that revolving credit back down to zero. Psychologically, there's this thing, if you have money in a savings account, you feel like it's yours and you can take it out more easily. That's what I've found. So my preference is we do use the revolving credit. If you are more of the shopper persuasion, we want to be very careful when it comes to revolving credits, because without the guardrails, and especially actually if there are credit cards involved. And so some of the advice out there is to put everything you possibly can onto your credit card, and then you pay less interest on your revolving credit, and then you pay that credit card off at the end of the month. So you're kind of getting that free credit, and your pay sits in the revolving credit, offsetting and lowering down the amount of interest that you pay. Great in theory, but when you are a shopper and you are using a credit card and a revolving credit, we sometimes call that a revolting credit, because without the guardrails in place, you are likely to overspend when you use a credit card. Because when you are a shopper, this is neuroscientific, you get a dopamine hit when you spend. And when you use a credit card, it's really hard to know, should I be spending this or should I not? Oh, well.
They're designed for that. They're
They are.
designed to be easy to spend through.
It's instant gratification versus delayed gratification, because you can get the thing in the moment and it feels really good, but the money doesn't come out of your bank account until the month after. So you're prone to overspend when you use a credit card. So that whole theory is great if you are incredibly disciplined. So the numbers and the maths works, but human behavior comes into it. And so it can really derail you. So we do not use credit cards with it. We set up some systems and some structures. We keep it off to the side separate if we need to, with a different bank if you need to, so we can't see it so it's easily accessible. All of these little guardrails to stop you from accessing it, even change the name of it to do not touch me, something like that.
Yeah, because the revolving, of course, as the name would suggest, like a revolving door, you can put so much more in there, but it can come back out. And if you think of it like an overdraft, and so if you're a great little debt angel, perfect, go hard. You can save into that. As you say, you're keeping yourself more financially secure. Brilliant. and you've got that backup plan that if it all goes wrong, you can take it out. The backup plan that you can take it out, it doesn't work if you are, like you say, a shopper, a spender, you've got the credit card attached. That money might just come out at that high interest rate, and then you're in big trouble. Not so fun fact. When you take on a 30-year mortgage, you'll probably pay more than double what you originally borrowed because of the cost of interest. The team at EnableMe specialize in taking charge of your money and growing your wealth, including how to get rid of your mortgage faster. Book a consultation with an EnableMe financial advisor today by visiting enable.me.
And I would also say, in the absence of a plan where we're working towards a goal, like saving is meaningless.
Yeah.
And particularly when you are a shopper type, even if you're a saver types save because it feels good to save. So they get their dopamine hit, weirdly, by putting money into a bank account.
Simply cannot identify, but love that for them.
When you are saving as a shopper, in the absence of a plan, you don't know why you're trying to be good and save. So it's not going to stop you from the spend in the moment. So you have to be really careful that you do have a plan in behind your savings regime, because otherwise, why would you not spend? But when you are operating a revolving credit and you are a saver, savers are torturous to themselves because they're so driven by saving. Sometimes they attach a lot of guilt to spend. So it's really interesting, the psychology. So when we're using a revolving credit to pay down mortgage, when there's a saver involved, sometimes, and this is not financially strictly optimal, but I have them have a holidays account separate. Because a saver can be so consumed with saving, they won't go on holiday. They'll flog themselves until the blinking mortgage is gone, but they're not going to take a break, and that's not sustainable. So sometimes it's permission to spend. So it swings both ways.
Isn't it funny that? Because I've often said, because I am spender mindset. But I've turned that into a superpower. I am a really good investor because it feels like spending. I feel like I'm like buying all these little bits of companies, and it's like, ooh, this is so fun. I definitely get that dopamine hit going into my account and being like, what am I buying this time? I'm not trying to fight who I am. I'm like, okay, this is who I am. How am I going to make this work for me? And so I love what you've said there about using that for the savers and being like, okay, you're not going to beat yourself over the head and not be a saver anymore. And there's so many great things about being a saver, but we also need to be open and acknowledge the things that you might just absolutely, as you say, flog yourself until life is miserable. Keep the little treats along the way, build them in a sustainable way that works for the goals. I actually think that's so important, right?
Sustainability to any plan, because as you said earlier, Frances, 5 years is quite a long time. It's short in terms of, you think a 30-year mortgage term, 5 years is a fraction of that. But in human terms, it's quite a long time to stick to something. So really important with any financial plan that we find that balance, and you're leaning into your money personality accordingly. So, to make sure that you actually do achieve. It can't be a crash diet.
No, exactly. Do not do the money version of a crash
fall off the
diet.
wagon.
Exactly. Yeah. Because when we pay so much more onto the principal, and I want to make this explicit because we've kind of hinted at it, but when you're paying so much more onto the principal, the amount that you borrowed in the first place, this is super powerful, right? Because as you said before about the compounding interest, I mean, it's a small interest rate-ish on a mortgage, but it's over 30 years. And I think when it's building up over 30 years, our brains are not designed to think about how much money that turns into. If someone say they're at the beginning of their mortgage journey, they've just bought their house and they're sort of getting settled in and being like, how do I do this smartly? I'd like to pay it off fast. I want it 5 years instead of 30. How much are we talking that you can spend here in terms of money that you're not going to be giving away to the bank?
I'll give you some numbers. So the average age to get on the property ladder now in New Zealand is 35.
Wow.
37 in Auckland. So that's been some recent research that's been done March this year. The average mortgage term is 30 years. So if you're 35, with a 30-year term, that takes you through to age 65. So we must accelerate the repayment of the mortgage because that system doesn't work. The average value for first-home buyers of a mortgage is about $550,000. So you are paying at around about a 5% interest rate, double. So you are paying over $500,000 of compound interest to the bank. So essentially you're buying a $500,000 property for $1 million, I mean, it's just
you're buying your house twice.
It's exponential, exactly right. those are the numbers. So people don't realize that. They think, well, I can make the mortgage repayment. That's all that matters. But do you want to give $500,000 to a bank? I don't.
I'm going to keep that for me.
I would say taking a 30-year term on your first home down to 5, I would aim more for the 10. Why I say that is when you go through the affordability calculations with the bank, they assess whether or not you can afford the mortgage at higher rates of interest according to your income. So debt to income ratio becomes really important, and the banks look at that as well. You don't know there's all this sort of stuff going on in the background. But
many calculators.
They do build in headroom. And so what we know to be true is if you have that debt to income ratio of between 1 to 4 or 5, so that means your annual income, how many times it goes into your mortgage. So if it's a $500,000 mortgage and you earn $100,000 as a household, that's a debt to income ratio of 1 to 5. So we should be able to take a 30-year term down to 10 years if your debt to income ratio is 1 to 5 for most people. And that's from the outset. And, at the very least, we want to be doing it in half the time in 15 years. So you think like the average first home buyer, you're 35. We want you to be getting mortgage free by age 50. Latest, because we've got to buy you time to get you investing towards retirement.
So, okay, if someone, you're chatting away to a friend at a barbecue and they say, I've seen this social media advice. Is there anything that gets put out there that you've heard about that is just categorically not a thing? Or, maybe just not a thing in New Zealand, because we do get a lot of American advice floating across our feeds as well. Like, is there anything where people talk to you about it, or they come into your office and they say, hey, is this a thing? And you go, no.
Yeah, there's a really American thing, which is a credit history thing. You have to get a credit card to build good credit history. All right, like that is a real American thing. Like it must be that you make your credit card repayments and you have some sort of score in the background. I don't know. That is not something we do here. So a lot of people don't realize that you can operate in this country without credit cards. And I would encourage everybody to cut up their credit card. Don't talk to me about air points, hot points, rewards points. I've done the math on it. It's not worth it because you overspend.
That's why they are there. They're there to encourage you to do that.
Do you think the credit card company is there for you?
Yeah, exactly.
They're there for the profit making and the shareholders.
Yeah, exactly.
So, be smarter than that.
And I think as well, I just wanted to take the smallest amount of time on what you said earlier about simply finding a way to make that extra repayment. That's what it comes down to, right?
Yeah, and it's consistency too. And that's the deeply unsexy, boring part is I'm afraid. You just need to be really consistent as a human until the mortgage is gone. But
damn it.
I can tell you when the mortgage is gone, and this is, again, one thing that people don't often realize is when you make a mortgage repayment on a table loan, it is the same repayment for 30 years. You make that repayment at that same level until you don't. But if you can accelerate and pay off extra principal and get mortgage free sooner, you're not making that repayment. So we're opening up the ability to invest, to wealth create, and actually have financial freedom. So financial freedom to me is we either have a mortgage-free home or know that we're on track to get that with our investments. And we have enough passive growth in terms of our investments that you don't need to work beyond a certain age. I calculate that age for my clients. It's really exciting. I can say to them, when you are 57, 60, whatever, you don't have to work anymore. That's that point where you can turn down that job offer, walk away from the job that you hate.
Go part-time and take more holidays.
Yeah. Says the shopper.
Yeah. I know. I always dob myself in on this, don't I? It's very obvious which money personality I have. Thank you so much, Shelley Palman from EnableMe. Now, if you have a question that you would like us to rip through, look at all the angles for you, send it through ask@franciscook.co.nz. We'll have that on the screen if you're watching the video. It's in the podcast description too. So all you have to do, copy and paste it across, send your email. Let's know what's on your mind. Until then, of course, make sure you've hit subscribe on Making Sense or send this episode to a friend if it helped you. Let's all get better with money together. And of course, have a great day. Just a note before you go. This podcast can only give you general information about how things work in most cases. It's not individual financial advice. We're all different, so some of this might not apply to your specific situation. Take what works for you, ignore the rest. If you're after individual financial advice, a financial advisor is always the best bet.